Netflix is set to report results tomorrow afternoon. With actors and writers unions in the U.S. going on strike, investors are kind of fearful about how it will affect the streamer's content pipeline. However, some analysts feel Netflix has the advantage in the second half of the year as the stock hits a 17-month high. You can check it out right there, 452.01 right now. Joining us is Paul Meeks. He is Independent Solutions Wealth Management Portfolio Manager and a finance professor at the Citadel. That's pretty cool. Hey, Paul, talk us through. How do you come down on this? Is the strike good for Netflix or bad?
I think incrementally it has to be bad for everybody, but on a relative basis, when you think about Netflix having the ability to produce programming abroad and also having a pretty rich pipeline that is very close to release. So maybe they'll be able to sneak some shows past the goalie before things get too onerous with the strikes. I think relative to other video streamers, they should be in pretty good shape. But of course, overall, industry-wide, it's got to be a negative.
What's the concern? I mean, we were talking yesterday a little bit about it, the idea that there are other outlets, there are other things that consumers could turn to, whether that be TikTok, whether that be self-generated stuff on YouTube.
Oh, I definitely think so. That's why I made the comment that overall it's pretty chilling, because in the past we've had strikes, but we haven't had for a long, long time a dual writer strike with an actor strike. And I'll tell you a funny story. I live in Charleston, South Carolina, on the water, right off my dock. Last week, Netflix is filming the show Outer Banks. Tons of equipment, tons of people, tons of actors. And the night that the actors went on strike, they shut it all down overnight. So I saw that in my neighborhood in real time.
Wow. Paul, what do you expect to hear, or what should we be looking for tomorrow night when Netflix actually reports? It's going to be a little backward looking, but we do have a lot of issues that were pretty important, including what they're trying to do with password sharing crackdowns.
Yeah, I actually think that the estimates are reasonable, and they'll probably not necessarily blow them out, but I think they pretty easily meet to beat. That's revenue, that's earnings per share, and it's also the big one, which is net new subscribers, which the street is expecting, at least formally, about 1.75 million. Buy-side analysts like myself are expecting much more. So I think that they will do quite well. But what we need to hear on the call, because it's more of a this quarter phenomenon than last quarter phenomenon, what is the financial impact on the crackdown on password sharing? Also, what is the ongoing traction in the move to the $6.99 per month ad-supported tier? Both of those questions, we'll get some more color on very soon.
What would be good color? What would be bad? What would make you think? What sort of revelations, just in terms of subscriber growth or talking about that $6.99 ad-supported tier?
The key thing is we know that it's taking hold, but what kind of impact on the P&L does it have, right? Because you will cannibalize some of your legacy business. Now, I would say that we've seen traction on that. Don't want to say it's necessarily rear view, but we have some evidence. The one thing that we don't really have evidence on, because it's really a next quarter phenomenon, as I mentioned, is this crackdown on password sharing. That will be on the come.
How long have you liked this stock? I think you've been with it for quite a while.
Yeah, I like it. Of course, a couple of times I've been scared to bejesus, right? Many, many years ago, as they give up their DVDs and go to a full streaming model. And then when they had a bleed of net subscribers several quarters ago, it gives you an opportunity once in a while when they have these retching changes in their business model, you get a 50% off. Because when this stock goes down, it goes down a hell of a lot.